Welcome to the taxation review for Chapter 6. Let's just jump right into it. Now in Chapter 6 we focused on income or loss from a business. Now what determines income or loss from a business? Well, it's important to distinguish the difference between business property and capital gains. Now business income is something that is active, something that takes energy and activity to generate. And the important thing about classifying income as business income is that for an individual, the business income is added to their earned income for RRSP calculation. So if an individual generates business income, they get to add that to their earned income, and that will increase their RRSP contribution amount. Now for a corporation, if the corporation is a CCPC, a Canadian-controlled private corporation, then they get a reduced rate of tax. And so once again, that's important to be able to classify income as business income because there are some tax advantages. Now, property income is passive in nature. So for example, if a company generates interest income from some passive investments, or they generate rental income, which is passive in nature, then that would be classified as property income. Now, for an individual, property income is not included in their earned income calculation for RRSP purposes, and once again, property income would not be subject to the reduced rate of tax for CCPCs. Moving on, there's also a third category, capital gains and capital losses. Now this results from the disposition of capital property, and once again, or depreciable property if the proceeds were more than the cost. And once again, for capital gains and capital losses, once again, 50% is taxable. Now, once again, when we were talking about the difference between business and capital income, we talked about the fact that if there was a taxpayer and they had a loss, they would prefer to treat that as a business loss because that would be 100% deductible versus a capital loss would only be 50% deductible against taxable capital gains. If there was a situation where there was a gain, the taxpayer would prefer to treat that as a capital gain because only 50% would be taxable. We talked about the fact that the CRA would have an opposing perspective, and so there's a list of criteria that have been established to determine whether or not a particular activity or disposition is business or capital in nature. We talked about primary versus secondary intention, the length of ownership, the frequency and number of such transactions, the relation to the taxpayer's business, the nature of the assets, and also for a corporation, what is their declared objectives on the articles of incorporation. So make sure you understand and review those criteria as well. Moving on to the next slide, we then talked about tax reserves. Now this is something that's quite different from accounting rules under GAAP. In the Income Tax Act, we have this concept of reserves. Now, a company or business needs to determine which reserves are available in a particular year, and the general rule is that if they're eligible for a tax reserve, they get to deduct that in that current year. Now in the following year, they have to add back last year's reserve and calculate a new reserve to determine if one is deductible. Now some common reserves, reserve for doubtful debts. Now the tax reserve for doubtful debts is quite often equivalent to a company's bad debts expense that is calculated under GAAP. There's also another reserve for unearned goods and services. Once again, this is very similar to the treatment for unearned revenue under GAAP. Now the third one is for unpaid amounts. Now this one there is no accounting equivalent. The reserve for unpaid amount basically says that if a company makes profit on a sale and they don't get all the proceeds in that first year of sale, they could take a reserve to defer the taxation of some of that profit. And basically the reserve is calculated as taking the gross profit multiplied by the outstanding proceeds at the end of the year divided by the total proceeds. Now there is a maximum 3-year limit for this, and part of the proceeds must also not be received until 2 years after the date of sale. So just remember that there are some specific rules that deal with whether or not this reserve for unpaid amounts is one, applicable, and two, how to do the particular calculation. Moving on to the next slide, There was also limits on business deductions. Some of the more common ones that we talked about was political contributions, not deductible. We then talked about the expenses of a personal services business. With a personal services business, that's basically a situation where an employee quits a company and then they incorporate a company and they provide those employment services back to that client, that original employer. And in that situation, the individual that incorporated their own company, their deductions would be limited to what an employee would get under 81H, H.1, I, and J. Now we saw those calculations back in Chapter 3. Another limitation is interest and property taxes on vacant land. So when land is vacant or producing insignificant amounts of income, the interest and property taxes paid can only be deducted to the extent of any net revenues earned on that property. Any amounts that are not deductible are added to the adjusted cost base of that vacant land. We also spent some time talking about thin capitalization rules, and this limits the amount of interest that a company pays to a non-resident shareholder. So if a company gets a loan from a non-resident shareholder, they pay interest. That interest is deductible. Now, that non-resident shareholder that receives that interest may not be taxed on that revenue, depending on the tax treaty between Canada and that country of the non-resident shareholder. So there is a specific rule saying that interest is disallowed if it's paid on debt in excess of a certain amount. And that certain amount was 1.5 times the sum of the shareholders' share of their contributed capital plus 100% of the company's retained earnings at the beginning of the year. So once again, just sort of know these rules with respect to thin capitalization. And the other deduction that we talked about was home office costs. And once again, these are different rules from when we were looking at home office costs for employment income. Moving on to the next, actually one more thing, meals and entertainment. Meals and entertainment, once again, subject to only 50% deduction. Moving on to the next slide, we talked about automobile-related deductions. Now, if a company owns their vehicles, they get to take CCA. Those vehicles will be allocated to Class 10 or Class 10.1 if they're considered luxury vehicles. Now, we also talked about if a company takes out a loan, a car loan, to purchase a car, then there's limits on the interest that is deductible as well. Basically works out to about $10 per day interest maximum. Well, there was also some complex calculations for when a company leases vehicles. If a company leases vehicles, it's the deductible amount is the lesser of three amounts. The amount that was actually paid. The second amount was based on this formula that we call the basic cumulative formula. Now remember, the basic cumulative formula limits high monthly lease payments. And then the third amount was the anti-avoidance formula. And the anti-avoidance formula limits expensive leased cars. So the reason that these rules were put in was, one, to basically discourage businesses from leasing cars that have a high monthly lease payment, thus the basic cumulative formula amount, and then also to try to discourage businesses from leasing very expensive cars, hence the anti-avoidance formula. And so once again, this calculation must be done every year to determine the maximum deduction that a business could take from leased vehicles. Moving on to the next slide, we then talked about how we reconcile a business's accounting net income prepared under GAAP to net income for tax purposes. And there was sort of a reconciliation schedule that we talked about. We said that a company would start off with their accounting net income, and then they would make a series of adjustments. Now, some common additions that they would have to make to their accounting net income would be accounting amortization. Now remember that for tax purposes, they get to take tax amortization or CCA. So if they've already deducted accounting amortization when calculating accounting net income, they would have to add it back. Another common addition, CCA. If a company has recapture on CCA, then they have to add that back as well. Remember, we talked about recapture of CCA. that is a situation where they dispose of a depreciable asset and there's a negative balance at year end. That means they took too much CCA, so they have to add it back. Once again, difference between accounting versus tax application. Also, any reserves they took last year. We talked about this earlier on in this tutorial, that a company gets to calculate tax reserves, and if they're eligible, they get to deduct it in the current year, but in the following year, they have to add it back. So another common addition is to add back last year's tax reserves. Moving on, accounting losses on capital asset disposition. If there were any losses included in the calculation of accounting net income, those would have to be added back. Now remember, for tax purposes, a business gets to deduct or gets to add the excess of taxable capital gains over allowable capital losses. So these are those 50% amounts. So any accounting losses, add those all back, and then a business will determine what is the excess of their taxable capital gains over their allowable capital losses. If there's a positive amount, they have to add that as well. And also, if a company is starting off with their accounting net income and they've deducted 100% of meals and entertainment, then when reconciling their accounting net income to net income for tax, they add back 50% of those non-deductible meals and entertainment expenses. Moving on to the next slide, let's look at some common deductions. Now, one of the most common deductions is CCA. In the previous slide, we said that a company has to add back their tax amortization. And so what they do get to deduct is their capital cost allowance or tax amortization. Now remember that CCA is a discretionary deduction. A business can deduct anywhere from 0 to the maximum amount. Also, any terminal losses. Remember we said that if a company disposes of depreciable assets, they deduct the lesser of cost and proceeds from the CCA class. If there's a positive balance remaining and there's no assets in that particular class at the end of the year, that full amount is deductible as a terminal loss. Also, tax reserves for the current year. Remember how tax reserves work? We add back last year's reserve and we calculate a new reserve for the current year, and we get to deduct any eligible reserves in the current year. Now, accounting gains on capital asset dispositions. Included in the accounting net income would be the 100% amount of any accounting gains on the disposition of capital assets. Now remember that for tax purposes, only 50% of those capital gains are taxable. In the previous slide, we said that a company has to determine whether there's an excess of taxable capital gains over allowable capital losses. If they are, they add that back. And so on this slide, any accounting gains would be basically deducted in this reconciliation. And that would basically bring us to a company's net income for tax purposes. Moving on to the next slide, we talked about farm losses. Now, if a business is operating a farm and that's that individual's chief source of income, then any farm losses would be treated as a non-capital loss, just like a regular business loss. Now, contrast that to a situation where there's an individual who's basically operating a hobby farm. They have no intent to make any money. In that situation, that activity would be treated as a hobby, not a business, and losses are denied. There could be a situation where there might be an individual who does some part-time farming. Maybe they have a full-time job, but they spend some of their evenings and weekends operating a farm. That would be a situation where they're considered part-time farming. They expect to profit, but it's not their chief source of income. In a year where there's a loss, they would be able to deduct $2,500 plus 1/2 of the next $30,000 of that loss. Any loss that is not deductible in the current year is considered a restricted farm loss, and that's only deductible against farming income, and that individual can carry it back 3 years and carry forward 20 years. We also talked about when there's a disposition of accounts receivable as part of selling a business. Now, an accounts receivable is considered a capital asset. So if a business sells their accounts receivable as part of selling their business, then that would be treated as a capital disposition. Now there is this joint election available under Income Tax Act Section 22. This basically tries to make the situation perhaps a little bit more tax beneficial to both the seller and the purchaser of that accounts receivable. Now normally, when the seller sells a capital asset that's treated as a capital loss, only 50% deductible against taxable capital gains. Now this joint election will allow the seller to treat the loss as a business loss, which would be 100% deductible. Now keep in mind this is a joint election, meaning that both the seller and the purchaser have to agree to it. If one party does not agree to it, then this election is not available. So the seller would likely want the election because they're probably going to sell their accounts receivable below the book value. And so they get to treat that fully as a business loss if the joint election is agreed to by both parties, rather than a capital loss which is only 50% deductible against taxable capital gains. Now from the purchaser's perspective, if they agree to this joint election, then they pay a certain amount for this amount of accounts receivable. If they collect below what they paid, then they get to treat that full amount as a loss as well, as an expense, and that's fully deductible. Now that's a good result versus treating it as a capital loss, once again, only 50% deductible against taxable capital gains. However, from the purchaser's perspective, if they end up collecting more than what they paid, they would have to include that full amount as income if they agree to this joint election. So once again, keep in mind that both parties need to agree to this joint election, and if they do, then it's treated as a business transaction rather than a capital transaction. And that brings us to the end of this Chapter 6 tutorial. Remember that all material in Chapter 6 is examinable. Good luck with your studies.